How's it going? My name is John Backron. I just want to do an introduction, a quick introduction to a possible retirement planning for a lot of those people that are self-employed. Self-employed means, you're getting paid based on your skill, but you don't really have any company backing you up for any retirement plans, any pension plans. So you got to create your own. Okay. So of course, this is not a means to take away from any investment vehicles that you may have, but this is a product which is called an index universal life that is in the form of life insurance that builds cash value within the market that'll create a lifetime income for you. So I'm going to share a screen real quick. Here's an example of a policy through FNG. Okay. This is for a client in this instance for age 35, female, non-tobacco user. Okay, this is just a standard rate. The rates can be cheaper or you can accumulate higher depending on your health. Okay, so there's 3 ratings. They got like a standard, a preferred, a premier, different names for it. But the healthier you are, the cheaper your cost of insurance will be, which means more accumulation will happen into the policy. But for this instance, this example, it's as simple of putting aside $300 a month, having a small death benefit first, but this will increase the cash value accumulation on the policy. So we're going to just go dive into the illustration. So how it works, as illustrated in here, your premium will cover the life insurance and additional premiums will go into the cash value. We're going to look at the current interest rate of 6.62 here. The way I set this up, if you're 35, we're just going to assume that you're going to work till 65, correct? So we're going to fund this policy for 30 years. We're going to pay $300 a month every month for the next 30 years. So by 65, you would have had paid a total of $108,000 into this. But by 65, your cash value, your death benefit, your cash value is at $315,000 and your death benefit is $488,000. So at that $315,000, this is where you can have systematic withdrawals as a lifetime income, and it's tax-free because you're borrowing out of your policy. Now, if you pass away, your death benefit will pay. Okay, but if you don't pass away, you can withdraw as much as you want out of the 315. In this illustration, it is set up starting at 65 to 66, where you don't make any more premium payments, but you can have an annual systematic withdrawal of $36,000, call it $3,000 a month as a lifetime income to you. And the way I've illustrated this is going to last you till 20 years, 65 to 85. Okay, well worth into the retirement. So this is going to continue to pay into you in about 3-4 years in, you've already gotten more than what you put into the policy. You put in about 108,000, you're getting more than that in 4 years. Okay. In fact, actually in 10 years, you're going to get out 364,000. Okay. Now, if anytime you pass away during that time, you still have a death benefit subtracted out of the cash value you borrowed. But more importantly, your cash value continues to accumulate while it's being built up into the policy. So let's look at age 80 in here. Age 80, you still have $102,000 of cash value, and you still have a death benefit of $147,000. But by the time you hit 85, you would have gotten a total of $729,000 into this policy. And if you pass away at 85, 86, you still have a policy of $83,000. The way I set this up on the illustration, you're no longer taking any more withdrawals. If you're not taking any more withdrawals, then your cash value will continue to spike up again because there's no subtraction out of it. So at the end, whenever you do pass away, you're still also leaving behind an inheritance to your kids, your family, and a generational wealth to your legacy. If you're interested in learning more, give me a call. The number is 562-335-8455. Thanks.